So recently, Jamie Dimon from JP Morgan said we may be in the most dangerous time the world has seen in decades. And that's a pretty scary quote coming from the CEO of one of the biggest financial firms in the world. And when I hear statements like that, I don't typically panic. I actually try to zoom out and ask, is my portfolio built to hold up across multiple possible futures, not just the optimistic bullish one? Now, I'm not looking to predict the future. I'm building durability. And if that's what you've been thinking about too, then stick around to see how I'm thinking about this crazy economy and what I'm doing to still build income, stay invested while creating a defensive strategy that will only strengthen my portfolio over time. So let's get into it. Welcome back all. Rico here. As always, none of this is financial advice. I'm not telling anyone what to do with their money. I'm just walking you through how I'm thinking about positioning my portfolio for long-term resilience. So some interesting things was also in the news lately. So Bank of America published 5 predictions for the future, and 2 really caught my eye: the AI workforce and the energy needed to support it. So AI and automation are accelerating productivity and reshaping roles across multiple industries. That promotes efficiency, but it also creates periods of adjustment. And AI isn't just digital. It requires massive physical infrastructure, which means electricity, water, cooling, servers, materials, distribution space. And for me, that signals a long runway for energy infrastructure, power utilities, industrial real estate, and looking at hard assets. These are the physical backbone beneath all digital progress. We'll get into what I'm doing with this information a bit later in the video, but I want to first start and share with you what I'm not doing in the next few months or even the next year. This is how I've looked at lots of income options, and I've looked at a lot during downturns. So strong dividend investments are always going to be good, like Microsoft, Coke, Pepsi, and consumer staples like that. Dividends aren't high, but they are pretty steady. And I do carry those in my non-taxable retirement accounts. But many people have even suggested or have started to look at defensive closed-end funds that use covered calls to generate income. For me, closed-end funds historically haven't aligned with my strategy. They're fine for some, but for me, because it uses a lot of leverage, the liquidity can tighten when there's volatility, and then some distributions include return of principal. So while those things may work out for others, they don't necessarily fit with what I'm building for my portfolio. And liquidity for me is super important. And if I find better long-term investments, I want to be able to make the shifts easily and quickly. And closed ends actually add friction to that way of thinking and that philosophy. So with that said, what are the pillars that I'm strengthening? So one is energy infrastructure. And so I remain long in Energy Transfer, ticker ET. It's a pipeline operator, meaning it earns revenue on volume moved, not oil price speculation. And this gives me cash flow stability even when markets move. Even though it's had a rough year, the distribution is still strong. Secondly, utilities that are actually powering the AI movement. So something that's new to my portfolio and I'm continuing to add to is VPU, which is the Vanguard's Utilities ETF. So AI growth depends on electricity and utilities. And these utilities own the grid. And it's the literal lifeline of the future economy. So for me, why I like VPU, it's defensive. So it's in utilities where everyone will always use the utilities. It's dividend supported, albeit modest, but still relevant that it pays a dividend. And it's structurally relevant for decades, just like many of the other Vanguard ETFs. And honestly, if there's a covered call ETF that plays in this space that I haven't discovered yet, please drop it in the comments below. If you know of any, I'd love to hear from you, or I'd love to hear how you're thinking about energy for the future and potentially in your defensive moves. Okay, the third is real estate that pays me to wait. So realty income is essential for me for retail cash flow. Pharmacies, grocery stores, dollar stores, these remain steady in most, if not all, market climates. No matter what the economy is going through, people need groceries. They need to eat, they need cleaners, foods, etc. On top of that, I'm staying invested and adding to IYRI, which is the NEOS real estate fund. This gives me exposure to industrial, logistic real estate, which benefits from a lot of other industries like e-commerce, supply chain modernization, and another thing, especially with AI, is data center infrastructure build out. So not only that, but it gives me that wider real estate exposure while still providing monthly income. And you know me, I'm all about income, and NEOS is one of my favorites when it comes to income. One thing I also want to share is I've actually stepped out of ADC for now, which is Agree Realty. Not because it's bad, but because O and IYRI fit better with the structure I'm reinforcing and the way I'm wanting to build my portfolio. And then fourth, I'm thinking about stability and income. So I continue to hold and add to my IGLD position, which is in gold. And this gives me some peace of mind because it gives me stability, which is gold. Plus it has an income overlay, which is the distribution, the monthly distribution. So this is what I mean by uncorrelated stability. So when the market moves, gold doesn't always move with it. And it helps to smooth the emotional experience of investing. So what that means is just because things like the NASDAQ go up doesn't mean gold is going to go up also. Also, if the NASDAQ goes down, it doesn't mean gold will go down. Gold operates independently of some of these bigger industries like tech or even consumer staples. And I'm also giving myself an asymmetric upside. And I'll tell you what that means in a second. But the way I'm doing that is I'm continuing to hold BTCI, which is the NEOS Bitcoin fund. And I've added blocks, which is a covered call ETF covering the broader crypto space. So let me define what asymmetric hedge means. It's a small position with meaningful upside potential that does not risk the core portfolio if it doesn't play out. So in other words, the crypto, it's not my core or my foundational investment. It's not the bedrock of my portfolio. It's my optionality with fairly huge upside potential. So we know crypto is pretty volatile, but there is a large cohort of people that are highly invested in crypto, and there's more action that happens in crypto. And I believe in its long-term play. So that's why I have this as an asymmetrical hedge. And then finally, the last thing I'm thinking about is my long-term core. And I will continue, no matter what the market does, I'm going to continue to dollar cost average into things like QQQI, SPYI, VGT, and VOO. And this is just my long-term backbone because historically, markets recover. Innovation continues. Compounding rewards consistency. So I want to stay consistent because I know all these things will have benefits in the long term. And as the saying goes, it's not about timing the market, it's about time in the market. And this philosophy is what allows me to stay grounded through all this uncertainty. It lets me build wealth without trading emotional peace that I have. And I'm going to say this again because it's the through line for everything that I do. I am not trying to predict the future. I'm building a portfolio that holds up no matter which future shows up. So whatever happens, I'm not going to be reactionary to it. I'm setting myself up so I'm prepared either way. Now, I want to know, how are you thinking about this economy? What are you doing, if anything, to hedge or stand pat? I'd love to hear from you in the comments to keep the discussion going. Please keep it kind, but always keep it coming. Thank you so much for watching. If you got value out of this video, please give it a thumbs up. Subscribe if you haven't already. It'd be amazing if you would share it with someone who needs it, who maybe isn't sure what to do in this weird economy that we're going through. And I appreciate each and every one of you. If it doesn't challenge you, it doesn't change you. And as always, messy action is better than no action. And I'll see you next time. Boom.